it's Vivian, your hot stock girl. Today I'm going to discuss real estate investment trusts, also known as REITs. REITs are companies that own or finance income-producing real estate. REITs are required to derive 75% or more of the revenue from real estate. The REIT must then distribute at least 90% of their taxable income each year in dividends to its shareholders. Investors like REITs for their relatively high dividend yields and the opportunity for the stock to appreciate over time. REITs often buy real estate in a range of property sectors. Office REITs primarily invest in office buildings. Residential REITs invest in residential apartment buildings. There are industrial REITs, healthcare REITs, hotel REITs, self-storage REITs, casino REITs, and data center REITs. There are even REITs that rent only to businesses that are in the marijuana industry. You also have specialty and diversified REITs that invest in a variety of income-producing property. REIT dividends will often be qualified dividends and taxed at a long-term capital gains tax rates. For most people, that means you only pay 50% tax rate and get to keep 85% for yourself. If you look at the long-term chart for most REITs, they have mostly gone up, except during the market downturn in 2008. So how can you not love REITs? Well, if you look at the 2-year and 5-year charts of many REITs, you will see they don't always go up. Depending on when the REIT was purchased, you can be down more in the stock price than you have made in the dividend. So why hasn't REITs gone up lately? As many investors know, the Fed has been jacking up interest rates and plans to keep doing it in 2019. Higher interest rates hurt REITs in 2 ways. First, it makes future growth more expensive. This happens because of higher interest rates that are paid for these acquisitions. Second, since REITs have a lot of debt, they end up with higher interest rate expenses when they refinance their bonds. Now, many REIT investors will tell you that if you hold the REIT long term, you will ride out the downturns and do well owning REITs. That strategy is true for REITs and most other long-term investments. I would suggest holding off a bit on buying REITs, at least until the Fed slows down the interest rate hikes. If you are a serious long-term investor who likes the dividend yield for REITs, you can take the opportunity and buy the dips to get a good dollar cost average. But please be aware of one thing with REITs or any dividend-paying stock with super high yield. A super high dividend yield usually means the company has too much debt and their dividends could get cut in the future. Or even worse, the company could be forced into bankruptcy by the bondholders because the debt covenants have been violated. Be sure to check out Moody's ratings and Moody's outlook for every REIT you decide to buy. And don't forget to diversify. Buy several REITs if you can, or buy a REIT ETF. So, there you have it. My thoughts on real estate investment trusts. I'm Vivian, your hot stock girl, and please be sure to subscribe below and check out my other videos for more great investment ideas. Bye!